Okay, let's have a look at another chart pattern that I really like. And in this case, I've chosen the stock of Diageo, and I have picked a head and shoulders pattern in 2004 to show and illustrate how to work this out. Now, again, several points I want to make. We are never going to get in, and certainly I'm not the type of trader who says, right, I got in at 726.5 pence, which was precisely the right point to get in. You'll notice how choppy these prices are around here when we're drawing these kind of support lines. That's why I draw them purposely here. You've seen it's not done right at the end with the microscope, but they're done in a very rough and ready manner. Because at this stage, we don't know if it's a head and shoulders pattern. We don't know at this stage. When the price starts falling to around here, we get a bit suspicious. Around here we get very suspicious. We get suspicious here. Well, what is a head shoulders? Well, it's where you've got three peaks, two shoulders, which are lower than the central higher peak, which is the head. So lower, higher, lower. You then draw a baseline from which the price rebounds. Well, it's rebounded here, here, here. And remember, you can only really draw this when you get the price around here. So you're only going to be in 1, 2, 3. You're only going to get 2 or 3 days notice on something like this. Okay, it's at this point we get suspicious, not anywhere earlier. People always complain with charting, well, you can only do it in hindsight, which is absolute nonsense. You can do it with a degree of foresight where you start getting suspicious around these kind of points. That's the first point. So you draw this line. Now, we don't know whether it's still going to be a head and shoulders. It's only a head and shoulders if the price breaks below this support line. In other words, it's a bearish pattern telling us to sell. If we're spread bettors or we trade CFDs or futures, we start going short only when the price is broken below the support line, which then begs the next question. Well, when has it broken? Look, it sort of broke here, well. Don't forget, that wasn't a head and shoulders pattern at that point, or here. So how do we know that it's so-called? One of the rules I like is that, as I've mentioned before, time and again, I like to make it a 2-day low or a 3-day low, and then the price to have moved a little bit lower. Again, the precise rule I choose, whether it's immediately after a small break, if it's a 2-day low or a 3-day low or a 3-day low and moved even a little bit lower, depends on how negative the news related to the stock is and how negative and bearish the rest of the market is. So I decide based partly on sentiment. I'm waiting for a price breakout. Why do I like this position? Because I'm a trend follower. I like to react. I like to react to stock direction once the price starts falling and get in on it. I'm not trying to anticipate the market moves. I don't want to position myself and be short Diageo when it's around these levels, because all that would have happened is it would have risen again and I would have got very sweaty palms. So we get in at maybe a 1 or 2 day low. Maybe we got in around this level, 710 pence, maybe 705. You might say, well, wait a minute, you just gave up 10 pence. These bits around here, I don't care. They're actually the most expensive bits ever to capture. Those bits right at the start of a trend and the ones right near the end of a trend are the worst to capture. Now, with a position like this where you've got so much volatility, we might have ended up making no money at all. We might have got in, shorted it then rose, took out our entries because our profit targets may have been as simple as, well, if it's a 3-day, 4-day high, I'm going to get out. Well, let me tell you how you avoid that position of being whipsawed. Because what you're looking to do with something like that in a stock like this is to avoid the situation where you short something and then it moves higher again. So, in this case, what we do with this particular stock, or with this type of chart pattern, is we work out, well, what's our profit projection so we don't exit too early? Well, profit projections with all these types of chart patterns can be calculated. So, with this one, the rule is supposed to be from the peak of the central, or the head, the central peak, all the way to the baseline, however many pence that is. In this case, it's roughly 60 pence. It's 720 down there, excuse my wobbly hand, to 785. That's about 60 pence. The idea is that 60 pence is then projected downwards from wherever the breakout occurs on this support line. And the breakout in the support line, 725 minus 60 pence. He does bit of quick mental arithmetic, takes us to about 665, if I'm right, and if I'm completely wrong, please email me anyway. But it's supposed to give us a level around here. There's a 60p break beneath this line, and you can see it's pretty much accurate. So how does that help us? Well, first of all, my usual exit rules for any position are that if it makes a 2 or 3 or 4 day high, I get out. Well, how do I choose between the 2, 3, 4, or even a 5 or 6 day high? The way I choose is, what was the negative news on the stock? If it's particularly bearish, then I'll give it more room, so I might say a 6 day high or a 4 day high. If the general market is bearish, then I'll say a 4 day high or a 6 day high. If the broader market is very bullish, and if there's no particularly negative news on the stock, then I might only say a 2 day high, and I'm looking to get out as soon as possible. Equally, if I've got a degree of uncertainty, then I'll get out of half the position at a 2 day high or a 4 day high, and the remainder a little bit later on. Now, with this kind of stock, so I would have looked at the stock specific news and the market news generally. If it was particularly bearish, and given that I know that the downside projection is around 665p, I wouldn't look to be too worried about a peak here. I might have got out a quarter of a position or half of it just in case, but I wouldn't be too concerned because I know I'm supposed to have a projection of around 665. With this, probably would have got out half the position because I would have thought, well, 665, we got near it here, so maybe I've blown it. So probably looked to have got out at a 2 or 3 day or even a 4 day high, maybe half the position there and the other half at a 6, 7 day high. So you might not have made a lot of money on this position because of that whipsaw, but so be it, that's the way it is. You don't always make money. It's not a science. It's not I got in at 0.1% below and I stayed in right up until this point. Sometimes you just can't handle whipsaws like this. It's the nature of the beast. That's why we keep on trading day in, day out. Why else do I like stocks like this and positions, chart positions like this? Well, I know where to put my stop loss. I know to put it just above this horizontal line, because if the price went there, just above this horizontal line, then I know that I must be wrong and that it's not going to continue falling. So if it fell beneath and then started rising above, I know I was wrong. It was a false breakout. The pattern didn't work. The pattern works 7 to 8 times out of 10, but I would have known it didn't work in this instance. That's why I like this position, because I've got a tight stop loss. I know to put it here, and I'll only lose 5 to 10 pence because it's going to go just here. And a 5 to 10 pence loss, when I'm looking at a downside of about 60 pence, maybe 50, even 40 pence, that gives me a 4 to 1 reward to risk ratio. I'm a happy bunny. I don't have a problem with that. That's why I like these types of positions. Tight risk control, clear signals, and it's a clear pattern on which we can continue building our trading systems.